we're hearing from the Fed and what we heard from the Fed yesterday is that they have a long way to go. They are not ready to pause yet. And that's going to be very contingent, this path forward on rates, based on the data that we continue to get. We have 2 jobs reports, 2 inflation reports before we get to that December meeting. So when we're trying to think about where does the Fed go next, does the Fed get to 5% on the terminal rate? Do they go beyond that? All of that is going to be very contingent upon the incoming data, and we get that first big data point tomorrow.
So what do you do with stocks in the meantime?
In the meantime, we're a little bit cautious on stocks. We're still relatively underweight, particularly as opportunities in the fixed income market look more and more attractive. We have been here before when we think about some of these short bear market rallies that we've seen throughout the year as the market gets excited about maybe softer inflation, maybe a softer Fed. And then we see the Fed throw cold water on that time and time again. We don't know where that ceiling on the federal funds rate is. Until we get there, we're probably going to continue to see some market volatility here. So we have to be a little bit more patient. But with rates at 4%, even if we get to 5%, a little bit beyond that, we're 80% of the way there. So I don't think we're far from potential positive catalysts from the markets, but we're certainly not there yet.
So you said you see opportunities in fixed income. You think yields are near their highs?
We might not be at the top of yields, and consistently this year, the entire market has been wrong about where the top in yields are. But I do think there's significant scope over the course of the next year for yields to come down. I mean, if we do end up seeing an economic recession at some point in 2023, which is fairly likely, the Fed acknowledged that narrow path for a soft landing, then that could mean that yields fall. So I'd say in the immediate term, we think more about shorter duration because yields might rise in the next couple of weeks and months, and we can still get really good income there. But if we think a little bit longer term, the next couple of months out and into deeper in 2023, we're thinking a little bit more about core bonds because those will be the areas of the portfolio that could protect if we do see an economic recession.
Right, and the yield, you get paid higher yields. So the market has had an interesting split this week in the value versus growth, cyclical versus tech. If you look at what's worked so far this week and today in particular, energy, industrials, healthcare materials doing better. Even financials haven't been as bad as, say, the tech stocks, communication services, consumer discretionary. Is that the right strategy as long as we continue to focus on the Fed moving higher with rates and Powell talking tough on inflation?
We'd still be relatively balanced between value and growth. I mean, I think that one of the very important points of the environment that we're in is it's moving and changing so fast. I mean, it has moved and changed so fast over the course of the year. Right now, we're finding more opportunities in value over growth simply because of that rising rate environment. But eventually, we will get to a point where the Fed does pause. And in that environment, that could lift one of the big headwinds that we're seeing for growth. We're also seeing that not only are valuations resetting in growth, but we're also seeing that big tech in particular going through a really challenging earnings season where a lot of that is resetting. So if we think about opportunities in growth going forward, once we get to a slightly more favorable economic environment, slightly more favorable rate environment going forward, there could be opportunities there. So we don't want to write it off. We don't want to abandon growth entirely, particularly if we head towards an economic recession when growth can do well. So we want to be a little bit balanced right now. That value is probably going to continue to outperform growth, but that could change in the coming months. So we want to be prepared and we don't want to be caught off sides.
Meera, Pandit, thank you for joining me to talk strategy. Really appreciate it.